For a farmer in India, credit isn't just some financial tool. It's a lifeline. It's what decides if they can sow a crop or have to leave a field empty. It's the difference between seeing a doctor or just hoping for the best. So today, we're going to unpack the incredible story of rural credit in India, a journey that goes from the tight grip of the village moneylender all the way to the complex modern financial system we see today. Okay, so here's how we're going to break this down. First, we'll get right into why credit is so fundamental for a farmer. Then we'll jump back in time to really understand the power the moneylender used to have. After that, we'll look at how a whole new system was built to replace that, and then we'll grade it, see what worked and what didn't. And finally, we'll take a look at what might be next. All right, let's start with the absolute basics. Why is having access to money, to credit, one of the most critical things in all of agriculture? I mean, really think about that for a second. For a farmer, there's no neat little lines separating their business from their personal life. A bad monsoon doesn't just ruin the harvest. It affects whether they can put food on the table or pay a doctor's bill. Their savings are often razor thin, and their income is anything but predictable. So borrowing often becomes the only way to get through the tough times. So when a farmer needs to borrow, it usually falls into two big categories. On one side, you've got what you might call productive credit, money for seeds, fertilizers, things that are going to directly help the farm grow. But then there's the other side, unproductive credit. This is for life itself, medical emergencies, a family wedding, or just buying groceries when cash is short. And here's the thing, both are absolutely essential for survival. And to make things even more complicated, all these needs run on totally different clocks. You've got the short-term crunch to buy seeds for the season. Then there's the medium-term goal, like maybe buying a tractor or digging a new well. And then you have the really long-term vision, like improving your land or buying more of it over many years. Any credit system that's going to work has to be able to handle all of this. So, with this constant, complicated need for cash, where did farmers used to go? Well, for generations, the answer was a system that was pretty much run by one powerful figure. Yeah, just let that number sink in for a second. 93%. Right after India's independence, nearly all the money being lent in rural areas came from informal sources. We're not talking about banks, we're talking about the local moneylender, the landlord, the trader. For most farmers, these guys weren't just an option, they were the only option. And here's the thing, that easy access came at a terrifying price. We're not just talking about ridiculously high interest rates. Imagine having your account books fiddled with because you can't read, or being forced to sell your entire harvest to the person you owe money to for a tiny fraction of what it's actually worth. It was a system designed to trap people in debt, often for life. Now, the government saw this happening and realized the cycle of debt was crippling the country's entire agricultural sector. So starting in the 1950s, they began this massive, decades-long project to build a whole new financial system from the ground up, one that could give farmers a fair shot. Now, this didn't happen overnight. It was a whole series of big moves. At first, the focus was on cooperative societies, owned by the members themselves. Then, in 1969, a real game changer. The government nationalized the country's biggest commercial banks and basically ordered them to go into rural areas and start lending to farmers. And finally, in 1975, they created special banks called regional rural banks, designed specifically for the little guy. So what you ended up with was this three-pronged attack to break the moneylenders' hold on everything. You had the local co-ops, the giant national banks, and these new specialized rural banks, all working to completely change how money flowed in the countryside. This whole thing was a massive social and economic experiment. So, decades later, what's the verdict? How did it all pan out? Did it actually work? I mean, wow, just look at this. The change between 1990 and 2020 it's seismic. The role of those local cooperatives shrank way down, while the commercial banks just exploded. They went from making up about half the market to over 75%. Clearly, that policy of forcing them into rural areas had a gigantic impact. And yeah, this chart pretty much sums up where we are today. The big commercial banks are the dominant players, no question about it. They're providing more than 3/4 of all formal credit to farmers, with the other two types making up the rest. So, let's look at the report card. On the one hand, mission accomplished, right? The moneylender's monopoly is pretty much broken. But, and this is a big but, the new system is nowhere near perfect. A lot of the poorest farmers still get left out, some regions get way more credit than others, and things like paperwork delays and people not being able to pay back loans are still huge problems. But, the story doesn't just stop there. To try and plug the holes that the formal banking system left, some really cool, innovative models have started popping up, writing a whole new chapter for rural finance. And maybe one of the most powerful of these is something called the Self-Help Group, or SHG. The idea is actually pretty simple, but it's revolutionary. Basically, small groups of people, usually women from the same village, all pool their savings together. That pot of money then acts like their own little community bank, letting them give out small loans to each other without needing any collateral. And get this, we are not talking about some small, niche project. By 2019, there were more than 64 million members in these groups. It's become this massive parallel financial system that's catching millions of people who are falling through the cracks of the formal banking world. And that really leaves us with the big question, doesn't it? We've seen the whole system transform from a 93% reliance on moneylenders to this huge network of banks. But has the fundamental reality for the individual farmer truly changed? The ultimate goal is still the same, making sure that lifeline of credit gets to every single farmer exactly when they need it most. And on that front, well, the journey definitely continues.